Hey everyone, Eric Dutram here with the latest edition of the Dutram Report, the podcast on ETFs and more. Today we have with us Bill Belden, Managing Director and Head of ETF Business Development at Guggenheim. We're taking a closer look at the bond world in today's edition, in particular their BulletShares Lineup. This series from Guggenheim is actually quite different than many of the bond funds currently on the market, and investors need to be aware of this unique entrant in the fixed income world. So if you have any questions or comments, make sure to send them in to podcast@zacks.com, and don't forget to find the Dutram Report on iTunes and give us a review there as well. But stay tuned for my chat with Bill right after this. Okay, Bill, thanks for joining us today. You're here to talk to us about the bond world, but in particular, a specific way that investors can target this market with ETFs using the BulletShares lineup. Now, ETF nerds like myself have been intrigued by this BulletShares approach for years, but maybe you can start off by telling everyone what makes these funds different than the rest of the bond ETF crop out there.
Yeah, great to be with you. And so thanks for your question on BulletShares, which we're very excited about. You know, again, it is an interesting concept and relatively unique in the world of ETFs and mutual funds. And really what makes them unique is that they seek to wed the best aspects of owning an individual bond and a bond fund. And so if you think of, the best attribute of owning an individual bond, many people would point to that defined maturity date. And that's what BulletShares or defined maturity ETFs actually have. So they have a predetermined maturity date similar to an individual bond and certainly distinct from your typical bond ETF or mutual fund, which are managed in perpetuity and don't have a finite life.
So how did you guys come up with this idea? Were you just not happy with the current crop of offerings that were out there?
So what happened is back in 2010, we partnered with a firm called Accretive Asset Management, who had done some work to identify what is really missing in the toolbox of advisors when seeking to meet their clients' needs within fixed income. And really that gap through some of that survey work was best identified as missing that linkage between what a fund can provide you and what an individual bond can provide you with. So started turning some dials and came up with the concept of the defined maturity ETF. We began collaborating early that year of 2010, and the guys from Accretive started the indexes in early 2010 that we licensed for inclusion in the BulletShares ETF. And so really, again, being focused on that financial advisor marketplace and what fixed income investors were actually using, we really felt like this fit a need that wasn't being met elsewhere in the marketplace.
So each bond fund holds securities in a given calendar year. What do you believe are ways that investors could, at least the average investor, could use this sort of approach for their personal portfolios?
Yeah, so I think that again, the BulletShares ETFs, which track the performance of an underlying index, and the index itself seeks to own the effective maturities of all bonds in a particular year. And really what makes them particularly attractive is the precision and specificity of that finite duration profile, which allows them to construct their portfolio with very specific attributes to meet their needs. And probably since we came out with them in 2010, the predominant use of BulletShares has been in building ladders. So a bond ladder, seemingly what's old is new again in terms of their appeal, and a lot of people are building ladders to provide for a more efficient and effective means of delivering fixed income exposure. And in particular, as we enter into a rising interest rate market by most accounts, ladders have been proven to be very effective tools in delivering that fixed income exposure. And what the BulletShares enable you to do is to construct a ladder in a really efficient way and a precise way that supports their use in that application. We're starting to see other uses as well, but for the past 6 years that the BulletShares ETFs have been in the marketplace, laddering has been the predominant use.
So what would you say the impact is in terms of interest rate sensitivity for these types of securities? Would you say it's fair to say that these might be a little less sensitive to rates than bond funds out there that have to keep reinvesting over and over, at least for the investors planning on holding until maturity?
That's exactly right. I mean, I think that the reason why they are really effective in a rising rate environment is, again, reminding folks that, a ladder basically takes different maturities, and as an investment, or in this case a defined maturity BulletShares ETF matures, the proceeds are redeployed in a later dated maturity, and that process continues to occur over the life of the ladder itself. And so the benefit of that is that you're getting that maturity event, which pays back the net asset value of the fund on that particular day, gives you that sum that you look to redeploy at the later dated maturity. And in a rising rate environment, that redeployment, if you will, occurs in a higher yielding product with a normally sloped yield curve, of course. And that finite life, as we said, helps mitigate the interest rate risk associated with rising rates, because, as we all know, as rates increase, the prices of bonds that are in the marketplace drops. And for a buy-to-maturity owner, if you hold on to your BulletShares ETF, then you'll recapture some of that lost value as you approach maturity when rates are rising.
So let's talk a little bit more about this final year of the bond funds. I know you guys have products that stretch out into the mid-2020s, looks like up to 2026 for regular corporate bonds, and then 2024 for high-yield corporates. But maybe we could use the 2017 corporate for an example. BSCH is the ticker there. So as we sort of approach, as we go further in the year, are bonds kind of not randomly, but going as we go along the year, are they maturing at different points? And then what happens at the end of the year? Is it just a cash payment on December 31st, or does it kind of cash get paid out as the year goes on?
Yeah, great question. And that's probably the question we get more so than any other when it comes to BulletShares ETFs. And so as you enter into the maturity year, basically the index that underlies the ETF is frozen, so it doesn't get rebalanced again. So those holdings are held for the entirety of the year. And what those holdings consist of, again, are bonds that have effective maturities within that particular year. And by effective, I mean they either actually have a maturity date in that year, or if they happen to have a call feature with a call date and they are likely to be called in that year, they can be included then in the product as well. So using BSCH as an example in 2017, as we move through the course of this year, as bonds mature, in the case of the investment grade, and I'll highlight this because it contrasts with the high yield that we also have, in the case of investment grade, any bonds that mature in the first 6 months of the maturity year are redeployed into remaining bonds held in the fund. And then beginning on July 1st, or the last 6 months of the year, any bonds that mature are held in cash equivalents, or effectively what they're held in as treasuries. And as that cash position grows from July 1st until the end of the calendar year, cash accumulates in the portfolio until the last business day of the year, when the net asset value of the fund is struck, which determines the amount per share that's being sent back to shareholders. And then that liquidation or maturity actually occurs, and the proceeds are sent back to shareholders as of that last business day of the year.
So what are the tax ramifications of this approach? Are there any capital gain issues that investors need to be aware of relative to some of the other bond funds out there?
Well, I think as with any bond fund or any security, to the extent that you buy it at one price and you sell it at another, that's going to be consistent with the maturity in this case as well. So you'll have a gain that you're realizing depending upon the price that you acquired the BulletShares ETF at and the price or that net asset value that is struck on that last business day of the year. So that provides a taxable event per se, and it could be a tax loss or it could be a capital gain depending upon what those prices actually are, similar to other ETFs. As it relates to distributions that happen during the time that you own the BulletShares ETF, we pay out monthly dividends. And basically, what those dividends are comprised of is the cash that accumulates in the fund from the coupons that are paid out in the underlying bonds over the course of the product's life. So, again, those dividends would be taxed as if they were any other dividend off of an ETF would be taxed as well.
Okay. And is 1 year in the series pretty comparable to the next in terms of sector breakdown, quality? For example, do you see a burst of telecoms in 1 year, or maybe, say, a surge in BBB rated securities in another?
The objective of the fund is to really seek what the exposure is within the market during that particular year. So it's conceivable that you could certainly get some overweightings in some areas relative to others, depending upon what issuance looks like over the course of that particular year. So, for example, I noted earlier that you can have callable bonds, and certainly high yield has significant amounts of callable bonds in it. And so if one particular sector gets hot and has call features that would move up the bond from its matured year into an earlier year because it's likely to be called, you could see some overweighting in some sectors, but it's generally been consistent with the weights that are reflective of the overall investment-grade corporate and high-yield corporate marketplace.
So are there any concerns in terms of, being overweight in one type of bond, or are there any sort of limits that in terms of a single security that can be held?
Well, one of the beauties of being in an ETF is you get the diversification associated with investing across a number of bonds in the underlying fund. So if you look at the BulletShares ETFs, for example, as of the beginning of this year, you would have seen that the 2017 portfolio has 318 bonds in it, and that goes all the way down to the 2026 portfolio, which has 126 bonds in it, and that will grow actually over time as that fund gets bigger. But across those kind of numbers, you certainly get good diversification at the security level. And in high yield, the range goes from about 100 bonds coming into the year for 2017 portfolio and about 45 bonds for the 2024 portfolio, which is the last fund that we have in the high yield suite. So you're certainly getting very strong security level diversification. And in high yield, that's particularly important, certainly because default risk is certainly material within high yield in contrast to investment grade.
So what do you think is next for BulletShares? Any thoughts on expanding into, say, foreign bonds, municipal bonds, or maybe even some long-term securities?
Yeah, we've been looking at that for a while. So we've been pretty active on the R&D side and looking at the next best asset class to deliver the BulletShares structure within. I can tell you we've looked at a range of different options. We're not ready to put anything on file just yet, but we certainly believe that the BulletShares structure lends itself to some additional fixed income asset classes beyond the domestic corporates that we're in currently.
And do you guys ever see any big bumps in terms of assets under management, as you go further down the years? Like maybe 2021 has a lot of assets, but then 2022, a little bit of a dip, and then 2023 back higher again. Are there any, sort of weird outliers in terms of interest by the years?
Generally speaking, I would say that they fall in line with, the maturity schedule. Certainly we will see from time to time some bumps in some products that correspond to, higher yield to maturity figures associated with 1 year over another. But certainly for generally upward sloping yield curve, we generally see the AUM correspond to that. And we've sent back almost $3 billion over the course of the past 6 years in the 11 products that we've actually matured, beginning with our first back at the end of 2011. And I think that at the end of this past year, we sent back about $711 million between the two funds that matured at the end of 2016. And if I look at the AUM across those 18 products, again, 10 being investment-grade corporates and 8 being high-yield corporates, we have just a little under $8 billion in AUM. And I would say that the bulk of AUM is in the near-term maturities. I think that that's also in part a byproduct of people trying to manage the interest rate risk and being a little bit hesitant to go too far out. But we are starting to see a little bit of a pickup recently in some of the buying activity in the later dated bonds. But I wouldn't say there's anything notable as far as an outlier other than, say, generally speaking, we see more AUM on the near-term maturities.
Okay. And sort of my last question here, why the name BulletShares?
Good question. So when we work with the folks at Accretive, and by the way, I should add that Guggenheim acquired Accretive in 2015. So we are actually now also the index provider for the BulletShares ETFs. But when we worked with the original founders at Accretive, we collaborated on the naming convention and came up with BulletShares because a bullet is actually a traditional term used to represent a defined maturity. And felt like, the BulletShares brand was something that we could jointly help build to associate these ETFs with what some understand to be a bullet concept within fixed income. And certainly we've found investors have gravitated towards that. So BulletShares, we're certainly doing a lot of activity to try to enhance and build the visibility for the suite, but we're certainly pleased to see those who have participated in owning the product have been happy with the results, and we think that there's a very attractive and exciting future ahead for the BulletShares concept.
Yeah, definitely. Thanks for coming on, Bill, and best of luck to you over at Guggenheim with BulletShares. And thanks for coming on and shed some light on this topic and this very interesting product type in the bond world.
Good to be with you, Eric. Thanks for the insight.
All right, everyone. That was Bill Belden, Managing Director and Head of ETF Business Development at Guggenheim. You can check out more information regarding his company's ETFs at GuggenheimInvestments.com and look for the BulletShares section on there. Well, hope you enjoyed this edition of the Duchin Report, and make sure to tune in for more interviews and discussions on the world of exchange-traded funds in the future. And for my thoughts on the ETF world, make sure to go on over to Zacks.com and check out the ETF Investor Service, which includes my top picks and commentary on the markets. And don't forget to find and review the Duchin Report on iTunes. And if there are any topics you want us to discuss, feel free to reach out at podcast@Zacks.com, my Twitter page @EricDutram, or leave us a comment on Facebook as well. And be on the lookout for a new edition of the Duchin Report each and every Thursday. But until then, for Zacks.com, I'm Eric Dutram.